Hey, welcome today, guys. Today is September 9th, 2025. You've got today is our, I don't know, maybe our sixth or seventh 12 at 12 with Paul Smith of 12 Rivers Realty. We've talked about a lot of things, man. We've talked about the overall economy, we've talked about entrepreneurship, we've talked about Austin economy, talked about things that the Fed's doing to help um, help spur the economy. Also, things that the Fed's doing to help mess the economy up. Things that the federal government's doing that's definitely trying to help screw things up as well. And I feel like we're kind of at that point, that culmination of all of the things are finally coming to a head of either, kind of like a make or break situation kind of within the economy, right? So the jobs report came out last week and it was lowered significantly from where it was previous month. And so the way that that works, right? So they came out with the August jobs report. And they had said that the U.S. economy had produced somewhere around, I think it was 75,000 jobs. And then they had now adjusted that down to 22 or 25,000 jobs, which means that unemployment went up. And so what that did is that caused the Fed is Jerome Powell. You're going to see him a lot in the news over the next couple months. What that did is that caused the Fed to no longer worry about inflation as much and actually to worry about unemployment. And so now they're looking at reducing rates. We were thinking we were going to get a quarter. There's a chance that we get a half point in rates. And if that happens and we get a half point reduction in rates, I think what we're going to see is, if we get a half point reduction in rates, that could be a bad thing. I think overall it could be a good thing as far as, lowering the rate for your car payment, potentially lowering the rate for your visa, lowering the rate for your commercial loans and short-term loans for sure. But then what that really indicates is that the economy is significantly worse than we thought or what they've been letting on. And then we'll see how that plays out. Maybe in the short term, I think it might not play out as great. As far as you'll probably see the Dow Jones drop, you'll see a bunch of other indicators drop. But then what you'll also see is mortgage rates drop, right? Last week we're seeing rates that got down into I'm seeing like 5.75%. Again, remember guys, every time, for every point that mortgage rates drop, from let's say from 7 to 6, that means that a buyer can afford 14% more house, somewhere in that 12 to 14% range. So kind of keep that in mind as you're seeing rates coming down. And so if you think about affordability and rates, and you think about that as a pyramid, as you go up higher on that pyramid and rates are higher and things are more expensive, there's less people that are going to be willing to buy and there's less people that can afford it. Well, as that kind of ratchets down on that pyramid, you're going to have more people that can buy and you're going to have more people who can afford it. And so what you're seeing now, just based off of those rates dropping into the fives, we're seeing significantly more mortgage rate applications. I think it's up 13% from year over year. And that's a big deal, right? And those are just people, there are people I think that are just chomping at the bit that want to own homes, specifically in Austin. I believe that, maybe not in every market, but I do think that in the Austin market, there's a substantial amount of buyers that would buy if they could. It's just maybe a little bit unaffordable. Or subsequently, they're kind of also just sitting on the fence right now, waiting to see what happens with mortgage rates. But as you see rates come down, I think you're going to see a lot more buyers jump in. The irony in that is that yes, you've got more people jumping in, which then also means that there's more demand. Well, guess what? That means that you're not going to get as good of a price, right? So if you think about the herd mentality of like, okay, rates are right, I'm going to go ahead and jump in. Well, if you and 100,000 people do that, now you're going to have maybe that swings the supply and demand the other way, where now all of a sudden it swings back into a seller's market in your specific area versus maybe it's a buyer's market where you're at now. Thus, you might end up paying more. That's the irony in that thought process, is that really supply and demand is where it comes in. I would much prefer to pay much lower for a house on price and then refi down the road versus have a lower rate and pay more for the house. And if anybody has an issue with that, think about people that bought in 2001 and 22 that can't get out of their homes right now. So that's just a, a thought process for me on why I want to buy while there's less demand, even with a higher rate, because I know at some point down the road, rates are going to come down. And that's what we're seeing right now is rates are starting to drop. And I think they're going to continue. Right now, rates are the lowest that they've been all year. And based on whatever Powell says, they might stay about the same. I think a quarter point's probably baked in. If he goes a half point, we'll see what happens as far as that goes. But that's going to be an interesting thing. I think that's going to be something that if you're looking to buy right now and if you're looking to sell, that's going to be an indicator. I think what also that's going to do is there's a lot of people that have been looking to, because from the pandemic and pre-pandemic, people that bought with a very low interest rate, they have been living in that home, and as life continues to happen, they might need to sell that home. They might need, maybe they had another child, maybe they have a parent that's getting older and they need a place for the parent to go. Um, which is all things that are kind of life events that would indicate that you maybe need to get a new home, either downsize or upsize, downsize or go, yeah, I'm sorry, either downsize or jump up in size. Either way, that would indicate that you would need to sell or you'd need to move. Um, but they've been waiting on rates. And so I think there's a pretty good pent up demand for that. I also think as rates drop, you're going to see more companies move because if you're a company that's headquartered, let's say in Detroit right now, I feel bad. I'm always beating the shit out of Detroit, but if you're a company and if you're a company that's in Detroit right now and you want to move to Austin, you don't want to you don't want to move your company down if they're in a 3% rate right now and they got to buy at a 7% rate. You're just kind of leaving them out to dry. So as those rates come down, you're going to see a lot of companies announce that they want to move to Austin. Man, shout out. I got my nephew Ethan in the house. Selma, what's going on, man? Hope you're well. Thanks for jumping in here. Obviously, we got Clarissa. Let's see. Somebody asks, can you talk about the options for sellers? Should they rent or sell? Well, that's really going to be something that is based on their situation, right? Is a situation a lot of times when a seller comes to me and they're like, should we keep it as an investment property or should we go ahead and sell the property? There's a lot of follow-up questions that come with that. Some of those questions would be one, if you sell it, what do you want to do with the money? Two, do you have equity right now? Is this a situation where if you bought it at the height of the market, can you get out of it? Or is this something that you need to keep it and then rent it out? And if you rent it out, is it going to be cash flow positive, cash flow neutral, cash flow negative? And if so, what does that mean for you and your family, right? Does that mean that you've got enough liquidity coming in where you can then kind of eat up that negative cash flow versus writing a check? Or does it just make sense to sometimes just take your lumps and write the check? And that's really something that's going to be determined based on your situation. I think everybody's different. Every property is different. If that's something that anybody wants to talk about, I'm happy to walk you down that path of kind of deciding the way in which that you should go. Because as we talk about the Fed reducing rates and interest rates coming down and the unemployment going up, specifically, one of the things that you'll see the government do is they start to do what's called quantitative easing versus quantitative tightening. So far with rates being higher, what they've been doing. Stu Butts in the house, by the way. Hope you've been well. Got a true alpha right now in the chat. No betas welcome. We all know that. If you're a beta, get your ass out of here. Alphas only. Ain't that right, Stu? So if it's a situation where the Fed and the government they're going to be making policy based on the whole market, right? The overall U.S. economy. And so things that are happening in other cities that are feeling more affected by a potential recession, that is going to help them revive their economy. But an economy like Austin, where we have a growing GDP that's going to double over the next 10 years, that that little bit of growth, or that basically for some cities it ends up being like a flint just trying to start a fire again. For us it feels like jet fuel, and because we already have a fire that's burning down here and we have an economy that's going in a recession. The Austin market still grows 2 to 3% a year, whereas a lot of other cities, they're going to contract. Because if you think about a recession, the point of a recession, or when you talk about a recession, it's that the GDP is going negative. Austin's GDP is not going negative. It's actually going positive, but not only is it going positive, it's going positive at a substantial rate. So when you start to do things for the rest of the US that's going to spur GDP in other areas, it means that we're going to get a multiplier in Austin that other cities are not going to get. Also, the other thing too is to have a city that's continuing to flourish, you have to have jobs, have to have positive job growth, and you have to have positive growth of people, right? If you have either of those two, if you have a job contraction, or if you have people contraction, or you've got a migration of people leaving your city, that is something that will definitely hurt your city. Again, this is Paul Smith with 12 Rivers, tuning into the 12 at 12. We're just talking about real estate today. We're really just talking about the Fed. We're talking about the overall state of the U.S. economy and what that means specifically for real estate. Obviously, when rates are lower, it means that real estate's more affordable. And I think you'll have a little bit of a Venn diagram where you have current prices and high rates. Well, when you start to get your rates lower and that pieces, that's that area right there where you're going to be able to make some money quickly. And I think that, it's pretty impossible to time a market. Typically, you'll know if the market's gone up or the market's gone down after it's already done that. There are people that just somehow sometimes get lucky as far as markets go. Danielle, shout out. Thanks for jumping in here. By the way, I hope you've been well. It was a pleasure working with you on this deal that we got going right now. Um, that's one of the main things is we're going to see over I think the next quarter, we're going to see a lot of policy coming out of the federal government and the Fed that's going to try to spur the economy. I think that's specifically based on the PPI numbers and the CPI numbers that just came out, as well as the job reports, right? And so if you start to see jobs reports where the U.S. is creating less jobs, you're going to see there's going to be some concern there, right? Because obviously the biggest concern so far has been inflation, but what's a bigger concern is stagflation. So stagflation is where you don't have appreciation or you don't have, I'm sorry, stagflation is where you don't have inflation or deflation. You actually have it where it's flat. And that is something that is worse than inflation. Obviously, the Fed has been raising rates over the past 4 years with the intent of trying to get inflation down to 2%. At the height of the pandemic, it was at 9%, which is just crazy. Um, and just a little tidbit on that. I guess it was like 2020, 2021. We took a trip to Italy, went to Rome, and I was asking a historian that was giving us a tour what happened to Rome, and she said inflation. Inflation killed Rome, and I was like, wow, didn't even think of that. Meanwhile, at home, you're seeing inflation at 9%, right? So I understand the importance of lowering inflation, and can kind of certainly see how that can go bad. But now it's like we're picking our poison to see now what's a worse thing to happen at that point. Man, Ryan, thanks for jumping in here, man. Hope you're well. Again, guys, this is Paul Smith with the 12 at 12. And what are we talking about today? Where is the rental market going? With rates going down and more buyers in the market. Yeah, I can see the rental market across the board in Austin. Again, this is in Austin. I think that rental rates in Austin are going to go up, and here's why. Last year, Austin added 60,000 apartments, and we absorbed 40,000. This year, we're going to add substantially more and absorb the same amount. So yeah, when we have a influx of new apartment inventory being delivered and we're not absorbing them, obviously you got to lower the rates for to get people to rent them out. And really what that affects is that really affects the say C and D level properties, the properties that are kind of on the lower end of the spectrum. Because if somebody is in a C property that now can afford a B property, they're going to move. Same thing with B to A. And so, really, what takes the biggest hit is kind of the properties on the lower end of the spectrum. Now, all of a sudden, with quantitative tightening happening, we're not going to be delivering as much inventory as we did over the past couple of years. Crazy thing about that, though, and this is where we start talking about the Austin effect over other cities, is Austin has more apartment inventory slated to deliver this year than any other city in the United States. And yet that's still not enough to meet the demand of the people moving to the Austin MSA. Again, we have about 40 to 50,000 net positive people a year moving to Austin, and we're not delivering that many apartments. And that number will continue to go down because it typically takes It takes anywhere from in Austin, it takes anywhere from 2 to 4 years to deliver apartment inventory, and that would be from a Lincoln Properties or an Endeavor saying, okay, we want to buy this property, to then going through the process of getting the site plan, which in the city of Austin takes about 18 months to 2 years, and then you got to build it from there. So anything that's coming online or they're looking to do right now models out to sell or to deliver in the next 4 years. So over the next 4 years, expect there to be less and less apartments being delivered. With the same amount of people moving here means that there's going to be more inventory. There's going to be less inventory, more people, which means that rental prices are going to go up. At the same time, as you start to see that, you start to see interest rates come down. Those same interest rates that are coming down on the Fed level are going to be the interest rates that are going to kick up apartment inventory down the road. Because if the Fed makes a half point reduction in the Fed rate, that means that your commercial rate that might be at 7% is going to be at 6.5. And that might be the difference between a deal penciling or not. It could be very close. But what that's going to do is, okay, you're going to have less apartment inventory, so prices are going to go up. And now what you're going to see is you're going to see prices go up on the purchase side of it because your interest rates are coming down. And that's again where you start to see everything kind of rise up at that point. You start to see investment properties to make more sense, because it's tough for an investment property to make sense with high interest rates and dropping rental rates. If you find an investment property that pencils out well at that, I think you're in a good spot, because I would say you're probably buying at the low as far as that goes for an investment property. And I think that you're going to see rates tick up. If you look at rental rates in Austin from 2008 to 2010, we saw anywhere from 10 to 20% rental rate appreciation year over year for multiple years. It was crazy. As a investment property owner, it worked out really well for me. As somebody that was renting, not so much, right? And so the way that I kind of always look at buying, and the analogy that I use is, whenever you buy, that's the snapshot that you take of that market. Now, as things become more and more unaffordable, you typically have to move further and further away from town, right? So if you think about it, if you're somebody that's on a relatively fixed income, that's somebody that's not going to be able to just increase your net worth or increase your the funds that you are earning on a year over year basis, then you're kind of got to be stuck at a certain price point as far as what you can afford for rent and or a home. Well, if we think about this, and dirt appreciates and sticks and bricks depreciate, the longer that we wait, the more that dirt appreciates, which means that you're going to be further and further away from where you maybe want to be, right? And so if you are somebody that works in downtown Austin and you're going to be capped at an income of $100,000 a year, that $100,000 is going to go significantly further in Kyle than it would, say, in 78704. But if you look at 20 years ago, that $100,000 would have done very well in '04. Now, unfortunately, your mortgage is going to be significantly higher in those areas. And so now you have to move further and further out. What I would love for you to think about, though, is think about the folks that bought 20 years ago in '04 that had the same type of a job that you have now. And that's that snapshot. That's the area where it's like, cool, I've got my snapshot of land at this time in Austin, and now I'm locked in on that affordability. Yeah, but once you put your homestead on there, you're able to also kind of lock in your taxes, so that way there it can't go up significantly more. Shout out to Austin from Austin. Austin Stowell in the house, man. Austin, I would love to have you on here at some point, man. You are a wealth of knowledge, and appreciate all you do, bro. So if you think about this as far as buying versus renting, right? Whenever you buy, you're kind of guaranteeing or locking in that snapshot for you, not for next year, but over the next 20 years. Because if we all agree that Austin is going to appreciate, maybe not substantially more over the next year, but historically, we've appreciated 5.7% a year since the 70s. And so if you're seeing that level of appreciation, the further that you go down the road, it's going to be literally the further that you're going to be able to live based on what you can afford. Just a thought as far as that goes. Obviously, in real estate, guys, you make your money when you buy. Denise Cook in the house. Denise Cook Smith. I'm still, I'm just gonna call her Denise Smith. Denise Cook's, that's Denise Smith. For those that don't know, Denise is my wife. She is actually the resident real estate expert in our house. I get all of my tidbits from her, as she's really good at regurgitating the things I say. So shout out to Denise for being in here. I mean, I didn't say that. Yep. See, I'm also available if you need an expert guest. Oh, great. Yeah, I don't know if they're ready for that, babe. they're not ready for this level of what's another word for bickering? Bantering is they're not ready for this level of bantering. Um, just a, yeah, just a thought as far as I can see. Look, now I'm flustered. I don't even know what I'm going to be doing next. As again, this is Paul Smith with the 12 at 12. I'm a owner founder of 12 Rivers Realty. Do a bunch of other fun stuff in the Austin market, as well as partnered at a bunch of bars, a partner in a sushi restaurant. If anybody wants to go, may the odds forever be in your favor. Yeah, it sells out in a couple minutes. If you really want to go, though, hit me up. I'll gladly put you up on the skip the guest list for those that are hanging out and watching. Let's see. Somebody over here in the Twitter world says 7 major U.S. cities are now officially buyers markets, despite delistings continue. Let's see. So somebody just sent me something here. Let's say they got Miami, no surprise. Austin, we'll see. And so I think it's very dangerous to say that one market is a buyer's market versus a seller's market, because it can be street by street, price by price, right? And so, talk about the Taco Bell collab. Thanks, babe. We'll do. Um, I think if you look at the overall macro of the city of Austin, yes, we can be in a buyer's market. And so a buyer's market is a equilibrium market of 6 months, right? So if you have 6 months supply, the thought process is that is a equilibrium market. Anything from 0 to 6 months is a seller's market. Anything over 6 months is going to be a buyer's market. And I think it's dangerous to go into just a kind of like carte blanche, we're a buyer's market versus either a seller's market, because it goes by price point. It can even go by street, right? It can go by certain types of homes. If you're in Steiner Ranch and you have a 3 bedroom home, there's a good chance that it's a buyer's market. But if you have a 5 bedroom home, it might be a seller's market. Why is that? Well, that's because that home, a 3 bedroom home in a place like Steiner Ranch, is going to be functionally obsolete, because most families that are needing family style homes in certain neighborhoods now, they're going to need a 4 bedroom with an office or a 5 bedroom with an office. And so a 3 bedroom home becomes functionally obsolete. All right, now we're going to talk about the Taco Bell collab. Guys, I don't know if you know this or not, but a Toshikan ATX is a sushi restaurant, an omakase sushi restaurant that I'm partnered with Chef Sane and CK Chin, and we're actually doing so Chef Sane is a huge Taco Bell fan, and so he's actually doing a Taco Bell inspired omakase this Friday. And so, the seats, basically what you want to do is go to Toshikan ATX, then go ahead and jump on that post. And I think you can enter as many times as you want, but you have to tag a friend and comment on what is your favorite Taco Bell food, basically. So I said Crunchwrap Supreme. Denise likes the Burrito Supreme. The chicken quesadillas are actually pretty good too. So pretty neat, right? So we're always trying to do different things. Yeah, we just did a Love is Blind collab. So pretty cool. Man, shout out. We got Matthew chilling, watching on LinkedIn. Matthew, thanks for tuning in. Guys, by the way, if you don't know, we're live on LinkedIn. We're live on Twitter. We're live on YouTube. We're live on Instagram. We're live on LinkedIn. Really kind of, campusing everything. We're actually on Twitch as well. Shout out to all the people watching on Twitch. It's really weird, by the way, when you're talking and you see your face on all these different things. It's kind of awkward, especially when you have a little bit of a delay. So all good there. Guys, again, this is Paul Smith with 12 Rivers Realty, doing a 12 at 12. If you have any questions about anything from, entrepreneurship, business ownership, how to set up a company properly, currently rocking about 30 plus LLCs. So done a bunch of fun stuff there, doing development, everything from single family development all the way to now working on a project that is going to be probably 350 units over off of Mopac. So it's really kind of that whole broad swath of the different things happening in the real estate market, and also doing some restaurant ownership stuff. The amount of people that hit me up that are like, "Hey, should I invest in this restaurant?" Um, I typically would say no, unless if you really, really know the operator, because man, restaurants can go to zero pretty quickly. And the majority of them don't pay back. So, if you're interested in investing in a restaurant, make sure that you know the operator and make sure that they have a lot of success. And then also just make sure to check to see are they taking a management fee, because a lot of restaurateurs and a lot of management groups are taking say a 10 to 25% management fee, which understood they need to get paid for what they're doing. But if it means that they're not, if it means that you're not going to get paid back, then that might be a problem there. As again, this is Paul Smith with the 12 at 12. Man, what do y'all want to talk about today? Clarissa, what do we got going on some of the other stuff here? Oh, definitely not talking about him. What else we got? Austin is building more new apartments than any other city. Yeah, we spoke about that. Mortgage rate demand jumps. Oh, you know, guys, if you live downtown right now and you're in the downtown submarket, specifically renting, I think you have maybe one more cycle at most before rental rates are going to go up. Paseo is getting ready to deliver, and that's the last condo tower or apartment tower that's going to be delivering in downtown Austin for a while. Again, because you have to not only get it permitted, but then you have to build it. And these buildings take anywhere from 2 to 3 years to build. So as that inventory gets absorbed, and as companies have employees start to come into go back to the office, you're going to see a jump in people moving back downtown. And again, activity breeds activity. So there's a little while where I felt like downtown was a little sleepy because everybody moved out. I think you're going to start to see a migration of people moving back in. And if that's the case, rental rates are going to go up. So I would say, if you're going to sign a lease, enjoy those low rental rates for probably one more year. But at the same time, as interest rates come down, I would start to consider buying. I do think that we're kind of in that sweet spot right now of lower interest rates, lower prices, but then also lower apartment rates. I do think that those things are going to go up, though. Guys, again, this is Paul Smith with the 12 at 12. Thank you guys for tuning in. As always, if you guys want to go jump over to ToshiCon real quick and sign up for the Taco Bell collab, if anybody wants to go hit up ToshiCon, let me know. I can give you guys, as we drop the next month, happy to give anybody that's tuning in an ability to go ahead and jump the line. What am I doing this weekend? Oh, that's a great one. Guys, I'm hosting an event at Devil May Care on Friday with Trackstar the DJ, who's a good friend of mine that is a DJ with Run the Jewels, benefiting Dawa. And so that's going to be at Devil May Care. Doors are at 10. Killer Mike's also going to be in town. Killer Mike is doing something with Dawa at a earlier event. I will go ahead and post the flyer today on both of those things. But again, all the proceeds from Devil May Care are going to also benefit Dow. That's going to be 10 o'clock on Friday at Devil May Care with Trackstar the DJ. Seb is going to be opening. And so, yeah, it's going to be a good time. And if you guys know anything about Devil May Care, it's always a vibe. Last event we did with Questlove, there was a line around the block and all the way around the other side. By the way, shout out to Alicia in the house. Alicia, thanks for tuning in. Guys, hope to see you this weekend. Thanks again for tuning in. Be good.